We're now at demonstration question 2-5. You start a business providing accounting services to small businesses. Record the following transactions into the basic accounting equation. Be sure to include both the indicator plus or minus and the amount. Let's page down so we can see all the transactions. There are 11 transactions which we're going to record into the basic accounting equation chart. Let's page down for the chart. We can see that assets equals liabilities plus equity. We know that every single time a transaction is recorded, it has to balance this equation. Assets equals liabilities plus equity. We're going to enter each of the transactions into this chart. Unfortunately, we don't have a column on the left-hand side for the numbers, so I'm just going to put the numbers in there. Let's start with number 1. Looking at the chart, we're going to read it. Made a cash investment in the business of $2,500. It says your business, but remember that we always record the transactions for a business from the business's point of view. So we're going to think about what did the business get and what did the business give away. 1. The business got cash, which is an asset with future economic benefit. So assets increase $2,500. What did the business give away? They actually gave away a slice of the business itself to you, the individual who invested in it. So in that case, that's owner's capital because that represents what has been given away by the business. Equity increases because owner's capital is part of equity. Equity increases by $2,500. Oh, it said to include the indicator. Notice that this equal sign still works because liabilities is 0. Excellent. Let's look at transaction number 2. Register the business name with Service Ontario for $60 using a business credit card. What did the business get? They got a business license, which they can use in the future and benefit the business by running it. Future economic benefit, that's an asset increasing $60. What did the business give away? They gave away a promise to pay the credit card company in the future. A promise to pay is a liability, so liabilities increase by $60. And the equal sign is still in perfect balance. Transaction number 3. Borrowed $3,000 cash from the bank. What did the business get? They got cash, which they can use in the future to benefit the business. So assets increase by $3,000. What did the business give away? They gave away a promise to pay the bank in the future, and that's a liability, an obligation. Increase $3,000. Moving on to transaction 4. Purchased equipment for $3,000 using the business credit card. What did the business get? They got equipment which can be used in the future to benefit the business. Assets increase by $3,000. What did they give away? They gave away a promise to pay the credit card company $3,000 in the future. That's a liability. Increase $3,000. Transaction number 5. Rented office space for a month and paid the landlord $1,700 cash. What did the business get? They got the use of the space in order to help them generate revenue. The word use should tell you right away that it's an expense. What do expenses do to equity? Expenses reduce profit, and therefore they reduce retained earnings, and therefore they reduce equity. So this has to be negative to the equity column, $1,700. Forgot to put the 5 there. Sorry about that. What did the business give away? They gave away cash, which is an asset. So there's no further future economic benefit, so negative $1,700. Transaction 6. Purchased supplies for $400 plus HST for cash. What did the business get? They got supplies which they can use in the future to benefit the business. So assets are going to increase, but by how much? Right now, HST is 13%. $400 multiplied by 1.13 is equal to $452. So the business got supplies which will benefit them in the future. Assets increase by $452. What did the business give away? Well, they gave away cash, which is an asset, so the asset also decreased by $452. Notice the equal sign still works. Assets in total changed by nothing. Liabilities changed by 0, and equity changed by 0, so it's still a balance. Let's look at transaction number 7. Provided services to customers and received $2,400 cash. What did the business get? They got cash from customers, which has future economic benefit. That's an asset. It increased by $2,400. What did the business give away? They gave away a service. They provided a service, past tense. And we know when a business provides a service, does their job, finishes the job, they have a right to claim revenue. Where should I record revenue? Revenues increase profit, which increases retained earnings, which increases equity. So revenues are a plus to equity. And the equal sign is still working. Let's look at transaction number 8. Paid cash of $100 plus HST to print flyers to advertise the business. They have not been used yet. So what did the business get? They got advertising supplies which they can use in the future to benefit the business. Anything that has future economic benefit is an asset. So assets increase by $100 plus HST. HST is 13%. Assets increased by $113. What did the business give away? They paid cash. So they gave away an asset at the same time that they gained a different asset. Assets decreased by $113 also. What's the net impact? 0 for assets, 0 for liabilities, and 0 for equity. Note that this is not recorded as an expense. Why not? Because it hasn't been used or consumed to help generate revenue. It has future economic benefit. That meets the definition of the financial reporting element assets, not the financial reporting element expense. Expenses can only be recorded when it has been used, consumed, or incurred to help generate revenue. Move on to transaction number 9. Paid for the equipment the business bought in item number 4. What did the business get? Let's quickly look at item number 4. In item number 4, the business got equipment and they gave away an IOU, a liability which indicated that they owed the credit card company in the future. So in transaction number 9, when they pay the credit card company, what do they get? They get back their IOU. They no longer owe anybody anything. Therefore, because they get back their IOU, because they're settling their debt, liabilities are going to decrease by $3,000. What did they give away? They gave away cash, which is an asset that no longer has any future economic benefit. Assets decrease by $3,000. And the equal sign? It's still working. Transaction number 10. Paid a student $200 to deliver the business's flyers to the neighborhood. All the flyers were handed out. Hint, this is actually 2 transactions. Use up the flyers, pay the student. Let's start with the first item, using up the flyers. What did the business get? The flyers were delivered, so the business used the flyers to help them generate revenue. As soon as I say the word use, you know it's an expense. And remember, expenses reduce profit, which reduces retained earnings, which reduce equity. So negative to the equity column, $113. Because remember from transaction number 8, that's how much the flyers cost. What did the business give away? Well, they gave away the flyers, and the flyers were an asset, but now they're gone, so they no longer have any future economic benefit. We've got to remove them from the asset, negative $113. Now, the student worked for the business. What did the business get? They consumed the student's services. They used it in order to help generate revenue. Those words, used and consumed, indicate that it's an expense. We know that expenses have a negative impact on equity, so negative $200. What did the business give away? They gave away cash, so the future benefit is gone, and assets decrease by $200. Notice both of these result in an equal sign. Let's go to the last transaction. Paid $124, HST included, for the use of the business phone for the month. What did the business get? They used the services of the phone company in order to generate revenue. That's an expense. We know that expenses reduce the equity column, so negative 124 in equity. What did the business give away? They gave away cash, so the future economic benefit of that cash is gone, and assets decrease by $124. That's it for the transactions. Let's now total each of the columns, because if we've done all these transactions correctly, the total of all the entries will balance just like each individual transaction balances. The total of all the assets is $5,823. The total of all the liabilities, $3,060. And the total of the equity, $2,763. And we see that there's perfect balance. That's the end of demonstration question 2-5. Thanks for watching, and I'll see you in the next video.